It was another solid day for stocks as the S&P 500 closed higher by 0.87%. That was driven largely by a cooler than expected inflation number this morning. And despite some news where we heard that a Russian missile may have landed in Poland, and that kind of jolted markets on an intraday basis, markets did rally into the close, showing their resilience once again. So we'll talk about all of that. We'll get into some conversation about currencies, especially the impact of the US dollar on things like gold and foreign securities. We'll have a conversation about some cryptocurrency. Of course, that's been a hot topic recently. And then we'll get into our trade application example, where I wanted to focus on a consumer discretionary stock that's trading at very high valuations, that's setting up for a bearish trade at a resistance point. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 15th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way we can be notified whenever we post these videos. We also post the stocks that are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got my S&P 500 heat map pulled up here in front of us. And it was largely a bullish day, kind of an interesting day as well. We started the session off quite strongly, similar to last Thursday, as a matter of fact, the last time I was with you, when that day I think we were looking at the CPI number. Today we were looking at the PPI, but both of them are inflation measures, both of them coming in a little bit cooler than expected, and thus giving a little bit more oomph to the substantial rally that we've been in the midst of here recently. Remember, the market is concerned about inflation right now, mostly because it's concerned about what inflation will cause the Fed to do, which is to hike their interest rates ever higher. And if inflation rates can start giving the appearance of cooling down, that might give the Fed the firepower to kind of slow down its rate of increases in the interest rate. But you know, I'm still a little bit skeptical myself around that. I haven't actually heard Jerome Powell come out and suggest that he's going to be slowing down the rate of increases in the interest rates. And so until I hear a little bit more from him, I still view this market as being thankful, as we're heading towards Thanksgiving here, of course, for a bullish rally that we've had here recently. It's been an amazing rally, and a lot of us have, of course, long-term investments that are benefiting from this huge move off of the bottom. But at the same time, I still remain a little bit skeptical as to whether this can continue into the future. Basically, if that is the bet that you're making, it's basically saying that you believe that the Fed will conduct or orchestrate a soft landing. And that is a very difficult thing to conduct. Obviously, we haven't officially seen massive recessionary environments yet with layoffs and all that kind of stuff. Yes, we're starting to hear that out of the tech space, but it has not been mass layoffs across the board like we experienced in 08, 09. And granted, that was a very unique time when a lot of things got a little bit ahead of themselves in the finance and real estate world. This next recession, whenever it may come, will be different than that. And so it is possible that maybe there won't be as many layoffs in a future recession. Nonetheless, we still have a fairly resilient economy at this moment in time. And we have an economy that does not appear to be cooling off dramatically yet. We still have an inverted yield curve. And, again, most inverted yield curves throughout history will eventually lead to some sort of a stock market give back. Again, this time could be different. That's what's interesting about the markets. Our nation here in the United States is relatively young. Therefore, the stock markets within our nation are also relatively young. And we have very few instances throughout history when we have major market moves like this. Even inverted yield curves do not happen all that regularly. regularly. So we have to understand that while we can look at the past to try to help us understand the future, it will never be perfect. So we've got to do the best that we can with the information we have at any given moment in time. And there's nothing that says that you can't play both sides, right? Some of you are going to be quite nimble with your short-term trading, perhaps leaning a little bit more bearishly, depending upon various trade setups, but you might also have a portion of your portfolio that is dedicated to long-term investing, similar to the dividend growth investing class that I taught here earlier today, where our account actually went positive. It went green here, that the account that we're putting together for dividend growth investing. So a lot of those dividend growth stocks are doing pretty well. In fact, as we look here at this graphic, you can see that a Dividend Aristocrat was actually one of the best performing stocks in the entire market today, and that's Walmart. Now keep in mind the difference between when we were talking about Walmart and Target and some of the other retailers back in the spring. Remember, back then we were talking about some of its biggest one-day sell-offs that we had seen in many years. Well, here it's the reverse. We got a 6.5% move higher on Walmart today off of their earnings announcement. We're going to hear from Lowe's and Target here in the short term, I believe tomorrow. We did hear from Home Depot earlier today, and they were a little bit more of a modest increase of only 1.6%. But the good news is the stock market's not cratering on every little whiff of negativity that is out there the way that it was back in the fall. And I think that's a helpful thing. It's constructive. And so we have to be on the lookout for opportunities when they do emerge, especially from the higher quality companies out there like your Walmarts and Home Depots of the world that are excellent dividend growth companies that could very well be part of your portfolios, on the long side of the equation that you've held for years and continue to benefit from. On the flip side, maybe you're trading in the short term some of those more bearish trade setups in the software or semiconductor worlds or what have you. So anyway, as you can see, mostly green here today off of that cooler than expected inflation print. But one other thing that I should mention real quick is that we did have quite the hiccup in the middle of the day. There was news floating around that perhaps a Russian missile may have landed in Poland and perhaps even killed 2 people there. So, whether that has been verified yet, I don't know, but that is what I've heard. And so take that for what it's worth. So that caused a little bit of a hiccup in what was otherwise a pretty strong session in the middle of the day, as there was fear that maybe the West would have to take action upon that, right? And while we're still kind of getting through that information now, we don't really know what action, if any, will be taken. And so it seems like by the end of the trading session, kind of cooler heads did prevail, at least from a stock market perspective, because we did get a rally into the final hour of trading after hearing that news there. So all in all, here's yet another day where the stock market is climbing the wall of worry and ended up with some pretty good results. Most stocks closing in the green here today. In terms of kind of more consistent patches, I would say that technology looked pretty strong today. Notice that Apple was up 1.19%. Microsoft is up just a touch. Those are the 2 bigger players. But even some of the smaller players, Salesforce and some of these other software companies like Adobe and Intuit and ServiceNow, they had some pretty nice days there, all things considered. And as you head down below here, you see some of your more IT services, tech-oriented companies, and alongside your semiconductors doing pretty well here today as well. Looks like IBM closed up by just 0.1%, but I think I heard them mention on business television earlier today that IBM was hitting a 52-week high, or at least very close to it. So remember, we've had a lot of dividend aristocrats that have been hitting 52-week highs here recently. Stocks like McDonald's and Caterpillar and Genuine Parts and Exxon and Chevron and Aflac. Now you can add IBM to that list. So the higher quality dividend growth stocks out there are vastly outperforming their various non-dividend paying counterparts in most cases. And that strikes me as fairly rational behavior and typical behavior, considering what kind of a year we're in right now, where 2022 has been a tough one for most. And for most investors, when times get tough, they start leaning into the higher quality element, the more consistent blue chip areas. And a lot of times that's where you're going to find your dividend aristocrat types of companies. In terms of where we saw maybe more consistent red or selling behavior, I'd probably throw healthcare into that camp. We actually had a pretty lengthy discussion yesterday in my top-down trend trading class about the behavior of healthcare on Friday of last week. I'm sure David probably talked to you guys about this with his presentations, but since the last time I was with you was on Thursday, I did not yet know this at the time, but on Friday we had an unbelievable amount of turnover under the hood. Many of you who follow me on Twitter would have seen a variety of tweets that I was putting out Friday and Saturday in that regard, because it was not normal. In fact, I was just going through some of the factor selector information for my class tomorrow morning, and we're going to have a major upheaval on our factor selector this week, and I think it really stems to what we saw Friday last week. It wasn't necessarily Thursday. Remember, pretty much everything was up on Thursday. I think 96% of the stocks were up that day when I was last with you. Friday was a very weird day where the stock market itself was up huge, but most of the recent winners were nosediving on Friday, and much of that money was rotating into the areas that had otherwise been forgotten about. So there was a huge amount of rotation taking place on Monday, and it kind of seems like that has hints of what happened today as well, because remember, Eli Lilly has been one of the strongest stocks in the market this year. So has Bristol Myers Squibb, so has Merck, Pfizer. These stocks were all down yet again today when the market was up. Here's another one, Cigna. Unfortunately, we've been trend trading that. We've actually been doing pretty well with it in one of my classes. But Friday, that thing got hit really hard there as well. So all of that kind of plays into that same theme, that there is actual rotation taking place underneath the surface of the market right now, and the algorithms are kind of going wild, basically liquidating and locking in profits on some of the best trades they had earlier this year and moving into the forgotten about names, hoping to get a little bit of alpha as we head into year end. So let's keep our eye on that theme, because that was a jolt to the marketplace from my perspective. It was something that was kind of out of the blue and out of the ordinary that is worth paying attention to as we head into the end of the year here. Remember, there should be a healthy amount of tax selling taking place this year as well. With this being a down year in the stock market, you know, what you tend to find is people kind of managing their taxes at the end of the year. And if they've taken huge losses in some of their stocks, they might want to offset those losses with some big gains they have in others. So when you have stocks like Merck and Eli Lilly that are still up nicely on the year, those gains that are being locked in right now by hedge fund managers and others can offset losses that they might be taking in some of the communication stocks out there, stocks like Meta and Alphabet and those types of companies that are down significantly this year. So I wonder if there's a little bit of that at play as well. So anyway, pretty strong day here across the board. Also, as I glance over here, I'm looking at Nike. Some of you might have seen my retweet here just a moment ago that Nike did increase their dividend by double-digit percentages after the bell tonight as well. So some more dividend growth heading that way for Nike shareholders. All right, let's go ahead and pop on over to the main part of the platform now. Take a look at some of our breadth numbers. I like to use this area of the Market Watch visualize area, where I've then pulled up the S&P 500, and you can see that of the 500 approximate stocks in the S&P 500, 380 of them were up today. So that is good for about 76% of stocks in the market being higher today. Again, compare that to where we were on Thursday, which was an overwhelming victory for the bulls. Remember, that was one of the best days in years that we saw on Thursday. But that day, we had 96% of stocks that were in the green. Today was 76, which normally would be viewed as a very strong day. It's only in comparison to Thursday where it feels like it's a little bit of a letdown. But all in all, obviously, when you got 3/4 of the stocks in the green, that is telling you that this is not an accident that the stock market was up today. There's a lot of participation across most sectors and industries helping support the market strength here today. Let's go ahead and now pop on over here to our charts. And as we kick things off here, this is chart 4B for those of you that are premium members. Remember, all of you premium members have access to the 50+ customized charts that David and I use on Thinkorswim. What we do is once someone signs up for our 3-year premium membership, we give them access to all of the importable shared links for the Thinkorswim platform. So that way they can kind of follow David and I a little bit more closely in our 10 premium classes throughout the week, in addition to these nightly free videos that many of you watch on YouTube. So don't forget about that nice perk, and again, just a friendly reminder, we're only a week or two away from our Black Friday sale. So if you're not on our email distribution list yet, make sure you are. Again, you can find that list in the description area of the YouTube video that you're watching. But I'm sure we'll send out emails about the Black Friday sale once it is up and running. So stay tuned on that, and we'd love to have you join our organization moving forward if it's in your budget and if you have time for it, obviously. So let's get into our foregrid here. And as you can see, the S&P 500 was up 0.87% here today. So a pretty decent day, not quite a 1% return, but still, considering the fact that we had potentially a missile land in a NATO country like Poland, the fact that we were up at all is rather surprising. We did close underneath that key 4,000 level on the S&P 500. You'll notice that we were at 3,991 when we ended. But earlier in the session, our high was as high as 4,028. So at one point during the day, we were above 4,000. We couldn't quite manage to close above 4,000. So we'll see if maybe that acts as kind of an obvious level of resistance. I know a lot of people have also been looking at 4,100 just because longer term downtrend lines from the top of the market here about a year ago would kind of match up pretty nicely with 4,100 being resistant. So there's a few different areas out there of interest right now from stock market participants, but all in all, I think we can all kind of objectively look at this chart and say, you know what, there's some pretty decent strength here. Just because there is strength doesn't mean that it will continue, obviously. I think we all know that. But there's a lot of people that believe that this market shouldn't be going up. I could very well be one of them. Yet we have to remind ourselves that in the trading realm, we should try to trade what we see, not what we think, right? Because sometimes thinking can get you into trouble or keep you out of perfectly good trades otherwise, just because you're too scared on the sidelines constantly, right? You can always come up with a reason why you shouldn't participate in the stock market. There will always be some negative news out there. And so we have to remind ourselves of that as well. Right now, if we're being honest with ourselves, we have reasonably good conditions right here with the charts that we are looking at, where we do have obviously a nice set of higher lows and a nice set of higher highs. And so the hope is, even if we do have a resistance area around 4,000 here, and let's say we start rolling back over as soon as tomorrow, then of course what we're going to want to see is for it to stabilize at its rising moving average, just like it did back here and just like it did back here. If it can continue to use that 30-day moving average as a launch pad higher, then we can actually build upon this. Right? Again, there's so many geopolitical concerns, macro concerns, things that are going on with the Fed and all this. I totally understand. But the truth of the matter is we actually have strong charts right now. And so we shouldn't forget that either. For those of you that, say that price is king and it's the only thing. Well, price right now is telling us that the market is reasonably strong, despite what a lot of people feel should not be happening, but what is happening. And again, the markets do have a habit over the years of climbing the wall of worry. And so perhaps we're in one of those modes right now where the vast majority of participants do not feel very comfortable in the market, yet the market finds a way to just eke its way higher and grind its way higher. Remember, we're also in the more bullish time period of the year from a seasonality perspective, with November, December, January tending to be stronger months of the year traditionally. But obviously that can be offset if Jerome Powell says the wrong thing at the next interest rate announcement as well. So each year is different, to be fair. But it is also true that maybe there's a little bit more jolliness in the environment this time of year, not just for holiday shopping and all that kind of stuff, but also shopping for stocks in the stock market. Maybe people are willing to get their wallets out a little bit more this time of year. We shall see. Anyway, pretty strong day, all things considered. Not perfect. We didn't close at the high of the day. We didn't close above 4,000, but being up here at 3,991 is a very strong sign compared to just a few weeks ago when we were talking about 500 points less than this on the S&P 500. It has been an amazing run that we've just had here in the last month or so. So we do remain with the strongly bullish intermediate posture. Notice the intermediate green line is in the upper reversal zone, and we are still trading above the rising 30-day moving average on the S&P 500. And really that's the case for all four of our charts today, right? Sometimes we have a little bit of distinction between our charts where we kind of point this thing out or that thing out. But right now, all four of these charts have strongly bullish postures and are trading above their rising 30-day moving averages. Naturally, there are some charts that are slightly stronger than others, and right now I would probably still say that it is the Dow that is the strongest chart, and it is the NASDAQ that is the one that is lagging, but it is lagging by still being bullish, and that is a different conversation than what we were having, back here, where it could have been lagging and, producing absolute losses. At least now we're actually starting to see some gains here, but you would like to see the NASDAQ start to establish a leadership role once again. Remember, stocks like Apple and Microsoft, as the largest market caps out there, have a much bigger impact on something like the NASDAQ than they do the Dow, even though they're in the Dow. But the Dow is price weighted, so a stock like United Healthcare is actually more important than Apple. Whereas in the NASDAQ and on the S&P 500, Apple is the most influential member of that index. And so if you want to see the markets, quote unquote strong, you're basically hoping that the tech stocks start to play a little bit of catch up, because they had been kind of out in left field here in the last few months in comparison to some of the other areas that have been strengthening. So we shall see if that is in the cards or not, but there has been a healthy amount of catch up here in the NASDAQ, to be fair. I mean, take a look at the green line on the NASDAQ down below here. Notice how sharp that rise is from right here on the 9th of November. That green line was at 33, and today it finds itself at 77. You compare that to something like the S&P 500, and it was at 67 on the 9th, and today it's at 88. So did it go up? Yes, but there is a more aggressive push in the NASDAQ, and that was something that we had been lacking prior to that. So that's at least one good thing that we can say, is that the NASDAQ is making an attempt to play a little bit of catch up right here. Even stocks like, Meta and Alphabet and some of those that had really fallen apart here a few weeks ago, they've actually caught a pretty nice bid here more recently. So there's been some decent snapbacks there that kind of add to the slightly more bullish tone of this market all of a sudden. So today the Dow was up 0.17%. It lagged from a one-day perspective, and remember, that is its typical relationship. Usually when the markets are up, the Dow goes up the least amount because it's your big blue chip companies. Typically what you see on big up days is that the NASDAQ is leading, and that is what we also saw today. It was up 1.45%. But the problem, again, is from an intermediate perspective, it's flip-flop. So from a one-day perspective, we saw what we wanted to see, which is the NASDAQ leading, Dow lagging. But from an intermediate time period perspective, it's the exact opposite. Dow is still leading, and the NASDAQ is still lagging. But, those things change. They will absolutely change in the future. That's the whole point of watching markets cycle as we do. And when there is a significant enough change, I'm sure we'll let you know about it in these nightly videos, as we always do. You'll notice in the lower right-hand corner that Russell 2000 was up 1.5% here today. So it was the second best performer after the NASDAQ, and I think that's also a fairly strong sign there, all else being equal. So again, not a whole lot of differentiation in the charts here today. All four of our major U.S. equity indices are considered strongly bullish according to the market forecast, and all four of them are trading above their rising 30-day moving averages, which is bullish behavior. Let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these free presentations. Remember, they take at least 3 hours for us to do on a daily basis here. And so David and I do have to ask ourselves regularly, can we afford to dedicate that amount of time to a free video that we don't really make any money off of? We do have that conversation and questioning and things like that. One thing that was interesting here with this whole FTX debacle that took place over the last week that I was just thinking about recently is there are other YouTube videos out there. Obviously, many of you probably watch lots of different traders and investors on YouTube, and that's probably how you found David and I. So you know better than I do because I actually don't watch a whole lot of those. But when I do watch them, it is interesting because a lot of finance-related YouTube videos and podcasts, I'm much more of a podcast guy because I have to go walk my dog every day. So I like to listen to investing podcasts when I'm walking my dog. So I'm actually bigger into podcasts than I am YouTube videos. But both of them, when I've had the opportunity to listen to them from other people, one thing that was happening this summer was that there were a lot of people that were shilling, the FTX platforms and exchanges and all that kind of stuff. And I thought that was a little peculiar when I was listening to it. In some cases, they were, podcasts and in YouTube videos that had nothing to do with cryptocurrency. So it was just a little bizarre to hear, these people whose, opinions I respect and all this kind of stuff. But then, in the middle of their presentation, they'd say, and tonight's presentation is brought to you by, XYZ crypto company or whatever it is. And right now I'm guessing that they probably regret having taken the paycheck, so to speak, and taken the bait there. Remember, David and I don't do that. It's not to say that we won't ever do that in the future. Maybe we will have a sponsorship opportunity, but I highly doubt it'll be in the crypto market. So remember, we don't get paid to do these videos. Sometimes you see some basic advertising from YouTube or whatever, but we're not one of those people that's shilling the latest, greatest cryptocurrency or coin or what have you out there. And hopefully that is valuable to some of you as you listen to us and know that we are kind of trying to stay true to who we are and sticking to our guns, and we're not going to be bought out by some latest greatest crypto exchange or something like that. So anyway, we do appreciate those of you that are willing to help support us by doing the most basic thing ever, just clicking like for us on our videos. That's all we ask out of you. Take 5 seconds out of your day, trade that in for the 3 hours that David and I spend on preparing these videos for you. The last time I did the video, you guys did not disappoint. 121 of you stepped up to the plate, and I appreciate each and every 121 of you. Remember, like I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video the next time I'm scheduled to do the video. Remember, I do them on Tuesdays and Thursdays. If we're under 100 likes, then I'll just plan on doing a 15-minute quick hitter video. So I let you guys kind of decide collectively. Do you enjoy the longer format videos where I go through more 12 grid analysis and go through trade application examples and things like that? Or would you rather just prefer that I report upon the markets very quickly and get on with things? So if you like the longer format, continue to click like. If you prefer the shorter 15-minute variety where you don't get quite as much analysis, then don't click like. And that way we'll know on which side of 100 likes we are as to whether we are being effective with our 3 hours that we dedicate to you guys pretty much every single day. All right, so let's do some shout outs here. I appreciate all 121 of you, including Les, including Arth, including Kirkeye, including Brandon, and Ace, and Brian, and Next Era Trading, and Lucius, and Jose, and Robert, and Adrian, and Ron, and Royal, and Victoria, and Ram, and Sephora, and Tim, and Claire, and Justina, and Tom, and HR, and Jim, and Iakipa, iGenomic. We've got Charles and Roger and Phil and others. Can't get to all of you. Obviously, I'd chew up too much time, but I do want you all to know that I see your likes come in. I appreciate that. Please keep it up on your end. It means a lot to both David and I. So thank you, thank you, thank you. We really appreciate that. All right. Also, let's come on over here to the Market Scholars website now and take a peek here at our sector selector tool. And this gets updated on Fridays, so just be aware it included Friday's wacky trading that I had mentioned before, where we saw a lot of prior leaders nosediving and a lot of stocks that were in the basement, rising. So that was included, but today where we had more of that follow through, it doesn't include today's information here. So this is something that our premium members have access immediately on Friday nights, but something that we do share for free here, later in the week after it's a little bit stale, but still gives us a pretty good idea as to what sorts of rotations may be taking place out there from a sector perspective. Now, once again, energy is leading the way, but I get the sense just by watching the trading here in the last week or two that there is a pinching of those bands. I can't remember if it was a week ago or maybe 2 weeks ago, somewhere here more recently, I was showing you guys that chart where I was saying it was energy and everybody else. Well, since I showed you that chart, wouldn't you know, energy doesn't seem to have quite the adrenaline that it did previously, and many of the other sectors are starting to kind of kick it into high gear. So I get the sense that there is a pinching of those levels here taking place all of a sudden, and it is possible that sometime between now and the end of the year, energy may fall off of its perch here on our sector selector. Obviously, when that happens, I'll be sure to report upon it with you. The other thing about kind of our top four, remember we use this graphic in my top-down trend trading class, and there we think in thirds, and what I mean by that is our pool of potential candidates that we're going to trade. There's 1,000 stocks that are on our radar. We want to look at the top third of those 1,000 stocks based upon our relative strength ranking method. Now, not only are we satisfied with the top third of individual stocks, but we want their sectors and their industries to also be in the top third of those respective, divisions as well. And so from a top third perspective on this graphic, since there's 11 things we're measuring, basically rankings 1, 2, 3, and 4 where we were fishing, if I could spit that out here this week. Now you'll notice that in that top four, we had energy, industrials, and financials all hold their exact rankings from the prior week. But where we did have a change, it was a massive change. Some of you saw me tweeting about this, I think, on either Friday night or Saturday as well, so you've seen this already. But what's kind of interesting about this is notice consumer staples were up here in the number 3 position last week. They fell off of the map. Remember, on Friday, stocks like Hershey's, as an example, in the consumer staples space got absolutely massacred with that huge turnover that I was mentioning to you earlier. It wasn't just the healthcare companies. There were consumer staples companies. There were military and defense companies. There was a lot of those once previous winners that really tumbled on Friday. So I do wonder if that is the reason we saw this massive drop back here on staples. The other thing that plays a role there is the fact that, when we are in a more bullish market environment like we find ourselves in right now, consumer staples oftentimes are viewed as quite boring investments, and they're there to help you in the tough times. But if you're really trying to chase performance when the market's in a good mood, you're usually better off going into some of the more cyclical areas. And that's probably a little bit of what we've had going on here in the last week or so as well. Now, notice that we went from number 3 to number 8 in the ranking here for the consumer staples. Now look at the exact opposite of that. This blue line right here, you can see that we have the consumer discretionary area that was ranked 8th last week and went all the way up to 3rd this week. So we had an exact swapping of the two consumer groups. Consumer discretionary, in other words, the wants and desires of consumers, and consumer staples, the needs of consumers, right? Consumer staples tend to be boring companies that provide food products. Think of something like a General Mills that, when the economy gets tough, you still have plenty of sales potential because people will still be buying cereal even if they lost their job in most cases. That sort of a mindset. Whereas consumer discretionary is, going out on trips. We talked about travel stocks to a degree in my class on Monday, casino stocks as an example. Even in this presentation here recently, we've talked about Marriott. And in fact, it's kind of interesting last week because I did the Iron Condor on Marriott, I think it was a week ago on Tuesday, for the trade application example here. And then the very next morning, in my factor-based swing trading class, the class voted for Marriott as our bullish swing trading idea. And by Friday, we were already out of that trade at max gain. So that's another example. Hotels have been doing pretty well here recently, all things considered. So, that's been kind of interesting to see that reversal take place. And a lot of it has been led by kind of some of those travel names that are out there. So keep that in the back of your mind if you're trying to hunt down more bullish trade setups here in this market environment. But you'll notice here that healthcare has fallen for 4 weeks in a row, kind of playing into that theme that I had mentioned to you about what was happening Friday with a lot of those healthcare companies getting hit. And then once again, that happening here today. So we might see healthcare slip down to maybe number 7 this Friday when I redo the graphic again. So we'll keep our eye on that. But there has been a little bit of give back there within some of that key healthcare area. And some of these other surprising areas like consumer discretionary are starting to perk up. Even if people don't want to believe it, it's happening. So it's been very interesting. All right, let's go ahead and get back on over here to our Thinkorswim charts, and let's do some 12 grid analysis. And we'll get started here with chart 5A. This is our asset class 12 grid. A reminder that the background colors of this chart will tell you whether the posture is bullish or bearish. If the background color is green, it's bullish. If it's pink, it's bearish. So as always, let's get started with the bottom 2 corners. Not to say that that is where we've always gotten started throughout history, but this year that has been the case, because what the market wants to know is what in the world is going on with interest rates. So down here in the lower right-hand corner, you see the 10-year U.S. Treasury yield. That's your effective bogey for trying to get an understanding of what direction interest rates are heading. And then nearly equally as important is what is happening with the U.S. dollar, and that is the chart you see in the lower left-hand side here. And with the dollar, you can see it was down yet again today. It was down 0.35%. And remember, this is something we have been talking about constantly in the last couple of weeks. And the reason for that is because of this failure at the 30-day moving average, which we saw in real time. Remember, we were talking about how it broke through this moving average, it had this rebound, and we wanted to give it the benefit of the doubt there because there were 2 other times this year where that rebound after cutting the moving average had led to higher highs. But as soon as a week later, when we were right back to where we started, that gave us the impression that, hey, this time feels different, at least for this specific situation. There could legitimately be a trend change taking place right before our eyes on the US dollar. And so far, here we are today, a week later, I have no reason to change my mindset around that. This looks like a broken chart. This looks like a broken trend. And that is generally a good thing for stocks in general, especially foreign stocks, but even here in the United States, since we have the good luxury of having so many multinational companies headquartered in the United States, having a weak dollar actually benefits stocks like Coca-Cola and Procter & Gamble and McDonald's and those types of companies. So it has been really interesting to see how quickly the dollar has fallen. Right? I would have recognized that this chart was looking shaky here, but I don't think I would have guessed in advance that it would have just fallen off of a map like it has. Just goes to show you life moves very quickly. And so there is a reason why David and I do these videos pretty much every single trading day, because things can change pretty dramatically even in a week, right? A lot of people that do kind of this freemium model that David and I do only offer you guys 1 free video a week, and then everything else is on the premium side of their business. But David and I give you, in most weeks, 5 free videos every week here on YouTube, in addition to everything we do for our premium members there. And I think the edge that we have in that regard, while it is a major time commitment and takes a lot of energy and effort, the edge that we have there is that we're likely not going to miss some sort of a major move like this, right? Because we're looking at it every single day. And that has been what has been happening here over the last week and a half, 2 weeks, or what have you. There has been an absolute decimation of the US dollar. All of a sudden here, we're talking about threatening 3-month lows on the US dollar when, you know, just a couple of weeks ago, we were up here closer to the highs. So it has been very violent to the downside. And I think that is part of the reason why the stock market has done so well here during that exact same time period. But again, I would point out, notice up here where we've got our foreign stock market charts. Look at that ascent of EFA. Look at that ascent of EEM. I mean, talk about like going straight up the pole type of moves for major zones throughout the world, right? These aren't individual countries here. Right? Sometimes you might have a certain piece of legislation passed in a country and all of a sudden people are rushing to buy their shares. But remember, when we're looking at EFA and EEM, those are broad generalizations of foreign markets across the globe, with EFA in the developed space usually representing countries like Europe and Australia and Japan, whereas we've got EEM that oftentimes represents countries like Mexico and Brazil and China and India, right? And so the point that I'm making is this is not the result of just one country getting a bit of good luck all of a sudden. This is the entire foreign equity market space basically going straight up here in the last couple of weeks. And a big reason behind that is what most of you are educated on if you've been with us long enough, that when the dollar goes down, you have more opportunities in the foreign stocks than you do oftentimes in the U.S. stocks, which they've done pretty well as well, but not nearly as well as the gigantic movements we are seeing, in some of those foreign markets. So that's another place that has been largely overlooked for trade setups in the last few years that could very well end up being very important areas that we look for future trade setups, right? We don't want to get too caught up in this idea of home country bias. Many of you are here in the United States like David and I are, but naturally on YouTube we have a global audience, so there are plenty of you that watch us from England and from Singapore and from China and wherever else in the world that you might be hanging out, right? So we always want to say hello to you as well, and we appreciate you checking it out. But especially here in the United States, we have to remind ourselves there's a whole world of investment opportunities outside of our borders here as well that may very well become quite valid for us as we move forward if you do expect the U.S. dollar to continue to have weakness. In terms of the U.S. Treasury yield in the lower right-hand corner here, you can see it is looking pretty ugly here as well. Not nearly as bad as the U.S. dollar. That is like just pulling the rug out from under it. The 10-year Treasury yield is being a little bit more stubborn than that, but there is actual hope here that maybe those were the highs in interest rates. I remain skeptical, admittedly, but I also can acknowledge what my eyes are seeing right now, which is this is good behavior if you are hoping that interest rates have topped out. Because what we saw here back on this day on the 10th, which was the last time I was with you, remember we talked about this, how good of a candle this was for the other risk-on assets when we saw the U.S. Treasury yield torpedo lower like this. And what I liked about it was not just the size of that red candle and filled in, meaning that we closed near the lows of the session, but how we had taken out that support on not only the moving average itself, but also some of these horizontal support areas right here. And you can see here we are now just a few days later when I'm with you again here on Tuesday, and it really hasn't improved. Yesterday it gave it an attempt, it looks like. It tried to bounce with interest rates, but today we rolled over again. Again, part of that is because of the inflation reading that we received this morning and those economic reports and macro reports and different things that come out in the news cycle do have an ability to impact a chart like this. But right now, just from an organic charting perspective, this is much better that we've seen in months in terms of the hope that interest rates will stop going up. This is an actual breakdown of a chart that's taking place here. Notice both the US dollar and the 10-year Treasury yield have strongly bearish postures at this moment in time with those red backgrounds there. I should also point out gold. This has also been extremely interesting. There's been a lot of interesting things happening in the markets here recently. If you can't sense it through my enthusiasm of my tone of voice and things like that, there's been a lot of very, very interesting educational things that of course we enjoy pointing out for you as well. But one of those things is gold. Gold is all of a sudden up here near its 3-month highs. In fact, it might have tapped it here this morning on an intraday basis before kind of settling in at the close. But we're basically neck and neck with where we were trading on gold exactly 3 months ago. And had you told me that on this day here, just on November 3rd, I would have looked at you like you were crazy. And so, hey, I'm just being honest. But that just goes to show that anything is possible in the markets. Gold has gone straight up, just like foreign stocks have gone straight up, and that's for the same reason. U.S. dollar is going straight down. When the dollar is weak, all else being equal, gold should be strong. And that's the exact relationship that we're seeing here. You will notice that we have this dark green background color telling us that we have a strongly bullish posture on gold. We are also trading well above a rising 30-day moving average. In fact, that might be the most bearish element of this, is the fact that it's so far above the moving average that you would have to figure there would be some sort of a give back along the way. But other than that, you love to see this type of strength. I mean, it has been robust, and it's the type of thing that it's been so jolting that it does have the potential to be truly trend changing. And remember, we've been talking about gold a lot this year, mostly because of how bearish it's been. If I were to right click on it and go to maximize the chart here so you can see this a little bit better, and we went back out, let's say on a 20-year monthly candle chart, remember earlier we were talking about how gold had just had its most down months in a row since the 1800s. You had 1, 2, 3, 4, 5, 6, 7 months in a row where gold finished lower. That is incredibly rare. And yet it just happened here in the midst of this 2022 year that we're all trading through. But here's what this 1 month looks like right now. This 1 month looks like it's just a straight up line, and there is a lot of favorable momentum in that line to the point where it probably caught a lot of people off guard that were trend trading gold to the downside, and then all of a sudden this happened so quickly that they've probably felt like they're trapped, right? Sometimes that happens. You know, this has been such an aggressive move. I'm sure there were plenty of people that were shorting gold that were like, well, I'll wait for a little bit of a pullback and then I'll flatten my positions. Well, guess what? We haven't gotten a pullback. It's basically been straight up along the way. So there's probably a few people that have been shorting gold that are probably sweating this move right now, which very well could provide, you know, the firepower for a continued move into the foreseeable future. Again, with the critical caveat being, do you expect the US dollar to be lower? And if you do, then I would say gold has a better than even chance of continuing its upward ascent. So fairly interesting to watch what's going on there with gold. Let's talk about Bitcoin here briefly. Of course, Bitcoin is the kind of the granddaddy of all the cryptos out there, right? There are a lot of Bitcoin purists out there that say all this garbage that's going on with FTX token and all these other exchanges and everything that have been imploding here lately, that does not take the sheen off of Bitcoin. And it's possible. Maybe that's true, right? Like I always say, it's important to have a flexible mindset towards that. It is possible that maybe Bitcoin does go up a tremendous amount in the future. But I think we also all remember a lot of people saying that Bitcoin would be $100,000 by the end of this year. And here we are looking at it at under $17,000. So you have to be very careful with people who are kind of touting that kind of stuff, as we've all seen here more recently. Sometimes, you know, there's the hype is a little bit beyond what is of the norm. I got to be careful with how I say it, because it seems like whenever I talk about cryptocurrencies, I'm going to end up offending someone. So that is not my goal. I'm just trying to tell it how it is, or how, at least how I think it is. And what I think it is right now is Bitcoin is suffering in the court of public opinion because of the bad behavior of other entities within the cryptocurrency universe. Even if it's not directly Bitcoin related, it has somewhat rubbed off on Bitcoin. And you can see that it has kind of just, you know, had almost a waterfall effect away from its moving average. It wasn't so long ago, right here during this time period at the end of October, where Bitcoin was actually firming up a little bit, right? Trading above its moving average, looking a little bit healthier there. But with all of this controversy in the last week or two with FTX and other crypto exchanges, Bitcoin has taken it across the chin as well. So it didn't quite cross below 15,000 at its lowest point yesterday, but it did cross below 16,000. So today it was bouncing back up somewhat nicely, but it's got work to do just to get back to that moving average. And right now it remains well below the falling moving average with a strongly bearish posture. No surprise there. But we shall see, right? If we get more liquid conditions once again in the markets and the Feds do become more dovish than they had been before, maybe, just maybe, Bitcoin will find a rally. But right now, clearly the trend is against that at the moment. Some of the bond areas are starting to look a little bit more impressive. So naturally, when interest rates are down, as they were today, so 10-year closed at 3.79 here today, and you can see that the inverse of that is bond prices go up when interest rates go down. And so that's kind of the relationship that we saw today. TLT is finally back above its moving average. It's been a long time since I've been able to say that. We actually still have a sold put going on TLT right now that I have been rolling over the last month or so. I was not one that had anticipated that it would go down as violently as it did, but here over the last month or so, at least we've been doing some nice recuperation in some of those types of trades there. And finally, we can say that the long-term U.S. Treasuries are above their 30-day moving average. Now notice that 30-day moving average is still falling. That's why it's listed there in yellow as opposed to having that line listed in green. But the hope is that if TLT stays above the moving average long enough, that moving average will start curling higher. We've got a ways to go before that happens, but just pointing that out just in case that's something that you're looking to see here out of the markets moving forward. So this is pretty much the first time since going all the way back, more than 3 months ago, where we've been up above the moving average this month, or this much, I should say. And that's a positive sign, right? It's not as big of a gap as what we were talking about with the S&P 500 here during this time period, or even where we're at right now. So we also have to take it in stride and not get too excited about this. But I think it is at least noteworthy that we are trading well above that 30-day moving average for basically the first time in over 3 months. So, we'll see where that takes us. The foreign bonds and the high yield bonds have been doing better. And remember, I've been talking to you about that over the last week or two as well. It had been the U.S. long-term treasuries that were kind of our laggards, but we already had the foreign bonds trading above their moving averages. We already had the high yield bonds trading above their moving averages, and that continues to be the case right now. Remember, the dollar being weak helps the foreign bonds. And with high yield bonds, really it's a measure of risk appetite. So there's a greater chance that when the stock market is strong and what we would refer to as risk on, then that would be a time when junk bonds would be acting a little bit better than when everybody's fearful that we're heading straight into an economic disaster. So I would put that in the bullish camp there as well. The fact that high yield bonds have actually held up pretty nicely here over recent weeks and months. Let's go ahead and take a look here at our sector 12 grid now. This is chart 5C for those of you that are following along at home. As we're looking at this, you can see the same thing that we saw on Thursday when I was last with you, which is a clean sweep of bullishness for all 11 sectors here in the United States. Of course, the upper left chart is the S&P 500 itself, followed by the 11 sectors that make up the S&P 500. So that's the good news. Now, obviously, there's always going to be some that are doing relatively better and some that are relatively worse, but it is at least a good sign, just kind of broadly speaking, that this market is going up in general, like we've said with the S&P 500, and it's not just the result of, a handful of sectors that are doing really well and masking the weakness in other sectors. All these sectors are kind of pulling their own weight to a degree. Again, some of them have a little bit more effort to put in, but all of these do have strongly bullish postures according to the market forecast at this moment in time. In terms of which of these charts are the strongest of the strong, I would probably say that energy remains the stalwart. Notice that we had a nice day in energy today, up over 1%, closing near the high of the session, and that's a new closing price high here for this year for energy. It touched a slightly higher intraday high yesterday, but did not close there. So today would be a better closing price for energy. So there still remains a fair bit of resilience there in the strength of oil and gas companies. Other sectors that I think are worth discussing from a strength perspective would be the chart just to the left of energy. Now, materials were down today. They were down 0.15%, but obviously that's close to break even, so not a huge deal. The candle looks a little bit worse than that, unfortunately, because we had a nice gap up to start the day, and then we closed in the red. So we have a little bit of a challenging candle right there. It's not quite the hanging man type of a formation because that body was a little bit too large right there. But nonetheless, it kind of gives you that same impression that we've got a little bit of a stalling out there on material. So we want to keep our eye on that. But the fact that we are up here basically neck and neck with 3-month highs is saying something. It's not as strong of a trend as what we saw with energy, but it is still worth mentioning that there's been enough strength off of the lows that we're talking about multi-month highs here for a lot of materials names. Same thing can be said for industrials. Now that should not come as a surprise because we've been talking about for a long time how industrials were some of the stronger areas, right? Whenever I share the sector selector with you, you can see that ever since the beginning of October, industrials have been ranked either number 2 or number 3. So it's been a month and a half since we've known that industrials have had relative strength. So it's not entirely surprising, but just confirming it for you that they remain among one of the stronger sectors that are out there. And then I'd also kind of throw my hat in the ring for talking about financials. Financials are also up here near their 3-month highs. Again, similar to industrials and materials, they don't have as pretty looking of a chart as energy does. But the fact that they got all the way off of the bottom here with that earnings announcement from JP Morgan kind of kicking things off and then going straight up to multi-month highs is saying something. Remember, there's a ton of market cap in the financials. So that's not just something that you can easily push around. It'd be much more easy to push around the materials sector. Financials, there's tons of market cap, tons of dollars flowing through that. And so it is worth at least mentioning that they have done quite well for themselves as well. All right, let's get into our trade application example here for today. And I'm going to pop on over here to chart 3A as our swing trading chart that we use on my Wednesday morning class. So I'll be using this tomorrow morning with our factor-based swing trading group as we select swing trades in that class. But for tonight's purposes, I just wanted to bring up a fairly well-known business. However, some of you may not be as well-known with its stock because it's one of the more recent IPOs in recent years, and that is Airbnb. Many of you have probably stayed at an Airbnb somewhere along the way, and you recognize that there has been a pretty dramatic shift in how people go on vacations. Used to be that you would pretty much almost exclusively use hotels. These days, many people, especially of the younger generation, feel just as comfortable staying in somebody's Airbnb than they do staying down at your local Hilton or what have you. So anyway, Airbnb kind of went public during that hype cycle during 2021. And has done a reasonably good job of retaining its value. It's not been perfect, but it's probably held up better than some of the other IPOs during that era. As you can see from the last 3 months, it's largely been going sideways to down. It's down about 12% over that time period, so naturally it is underperforming the S&P 500. And you can see that after it reported its earnings here most recently, the stock nosedived from this falling moving average down to this low point of 91, and then has spent the last couple of weeks going right back up to that moving average once again. Now, once we get there, I'm always wondering, is that where we are going to find some selling pressure? That's a natural point for the market or the technicians out there to kind of start thinking about doing something bearish with it. The other thing I would mention is we did fill the gap there between this candle and that candle. So if there were some bulls down here that were thinking that was a possibility, they might have accomplished their goal and now they've gotten out of their trade, right? Giving way to perhaps more supply on the market than demand for the shares. You'll also notice that we ended today with a fairly long upper shadow, giving us the impression that there were sellers at the top of the candle here today. So it wasn't just a runaway freight train for the bulls. And so you can also see that the background color of this chart went to pink from blue, telling us that this near-term line is now considered more bearish for swing trading purposes. And you also have the moving average color red once again. We had green right here when price got above the rising moving average. The next day the price fell. The moving average is still rising, so that's why it was colored yellow. And now today price is back below that falling moving average. And so I'm kind of wondering, is this going to be a stalling out point after a really good bullish effort down here? And will the bears start creeping back into the system again? So what I did was I did what's known as selling a bear call spread, which, obviously by the name is a bearish trade. And what I did was I used the December contracts and I believe I did the 115 as my sold strike and the 120 as my long strike. And I collected, I think it was $1.36. You can see this line that I've drawn up here in the blue basically represents my break even, because remember, if I took in $1.36 to do that trade and my short strike was at 115, then I can add the $1.36 to the 115 to come up with what my break even is. So basically, for those of you that are newer to the options world, what I want to have happen with this trade is for Airbnb to close below this blue line in the middle of December. That's when that options contract will expire. If we close below there, then I'm going to have a 30% or 37% return on risk on this one, which is a little bit more than I usually go for, but I was limited in my strike selection with this one. So normally I shoot for about a 30% return on risk. This one was a little bit more than that, 37%. So if it works out, I get a little bit more benefit from that. But it does require us to stay below this blue line. So if you're somebody that believes Airbnb is just going to keep on going here, and it's going to wreck its downtrend and start moving to the upside, and this is a trade that obviously you would want to pass on. Otherwise, if you think this will be a little bit of a stalling out point for you, then this is a trade that could make money if it remains below that blue line on expiration date. And remember, I already did the trade. Trade was done while the market was open here today. I already sent out all the trade confirmations and all that good stuff to those of you who are premium members on our private Telegram channel. So that gives you guys a little bit of an information edge to learn about the trades before the free videos go out later on that night. Okay, so that's what I had for you here tonight. I appreciate you checking out this video. If you appreciate the effort that I put into it, I ask one simple request out of you. Click like for me there on Twitter. It only takes you 5 seconds, doesn't cost you a penny. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Thursday, I'll plan on doing another full-length video just like this one, including a trade application example. On the other hand, if you prefer the 10 to 15 minute type of variety of video that doesn't go through trades, only goes through the major market averages, then don't click like. And if we're under 100 likes, then I'll plan on just keeping it nice and short for you there that time around. Okay, so I'll let you guys decide there collectively, but again, appreciate you checking out the video here tonight. Best of success with your trades and your investments. Goodbye for now.